You can have a strategy that looks incredible on a chart. You can backtest it and win 7, 8, even 9 trades out of 10, and still lose money when you take it into the live market. That sounds crazy, but this is where many traders make their biggest mistake. They confuse a good-looking strategy with a tested trading edge. In the last video, I showed you my NAS100 NYSE Liquidity Strategy. We looked at the liquidity, the sweep, the displacement, the structure break, the retracement, and finally, the entry. If you're just joining this series, or some of those concepts aren't completely clear yet, I recommend watching the first NYSE strategy video on my page before continuing. It will give you the full breakdown of how the setup works, so you can understand everything I'm about to explain in this video. But there was one problem. Knowing the setup is only half the battle. Because before I can confidently say this strategy works, I need evidence. I need to know, how often does it actually win? How much does it make when it wins? How much does it lose when it fails? What happens during a losing streak? Does it still work when market conditions change? And most importantly, can I actually execute it consistently with real money on the line? Because a strategy isn't an edge just because it worked yesterday. An edge is something you can test, measure, execute, and potentially reproduce over a meaningful sample of trades. And that's exactly what we're going to do in this video. I'm going to show you how I test this NAS100 strategy, what I track, what I learned from taking it into the live market, and how I determine whether I actually have an edge, or I'm simply looking at a pattern that happened to work for a while. So let's start with the first thing every trader needs to understand. Backtesting doesn't prove that your strategy works. It gives you a hypothesis. Now let's see if that hypothesis survives the real market. Chapter 1. Backtesting doesn't prove you have an edge. Let's start with something that took me a while to understand. Backtesting is important, but backtesting alone doesn't prove that your strategy works. Why? Because when you're looking at historical charts, you already know what happened. You can scroll backward. You can see where the liquidity was taken. You can see the displacement. You can see the perfect entry that happened afterward. And that's where hindsight can become dangerous. You start thinking, I would have taken this trade. I would have entered here. This one would have been a winner. But would you really have taken it if you were watching the market live? That's a completely different question. And this is why I don't want you to look at a strategy and say, it worked 80% of the time in backtesting, so I have an 80% win rate strategy. Not necessarily. You might have tested too few trades. You might have ignored setups that didn't look clean. You might have entered trades slightly differently every time, or you might have unknowingly changed the rules while testing. And that's exactly how traders create false confidence. So when I started testing my NAS100 NYSE Liquidity Strategy, I had to change the way I looked at backtesting. I wasn't trying to prove that my strategy was good. I was trying to disprove it. I wanted to find out, where does this strategy fail? What market conditions make it perform badly? What happens when the sweep doesn't lead to displacement? What happens when price sweeps both sides? What happens on low volatility days? What happens around major news? And what happens when the market simply doesn't give me this setup? Because if I only search for winning examples, I'll always find them. But if I deliberately look for the failures, that's where the real information is. And this leads to the first rule of proper strategy testing. Don't test to prove your strategy. Test to find out whether it deserves your trust. That's a completely different mindset. And once you understand that, you can start collecting data that actually means something. Because one trade means almost nothing. 5 trades mean almost nothing. Even 10 trades can give you a very misleading picture. You need a meaningful sample size. And more importantly, you need to record every valid setup, not just the ones you would have liked to trade. Because the goal isn't to create a beautiful backtest. The goal is to discover the actual behavior of your strategy. And that's where the numbers become important. Because instead of saying, my strategy feels profitable, we need to ask, what does the data actually say? And that's what we're going to measure next. Chapter 2. The numbers that actually matters. Now, if we're going to test a strategy properly, we can't just count how many trades we won, because win rate doesn't tell the whole story. A strategy can win 80% of its trades and still lose money, and another strategy can win only 40% of its trades and still be highly profitable. So what actually matters? The relationship between your wins, your losses, and your risk. Let's say you have a strategy that wins 4 out of every 10 trades. At first, that might sound terrible. But imagine your average winning trade makes 3R, while your average losing trade loses 1R. You could lose 6 trades and make 6R from them. But the 4 winners could make 12R. That's a plus 6R result across those 10 trades. So instead of obsessing over win rate, I want to know several things. Number 1, win rate. How many of my valid setups actually produce a profitable result? But remember, win rate is only one piece of the puzzle. Number 2, average risk to reward. How much am I making when I'm right compared with how much I'm losing when I'm wrong? If I'm risking 1R to make 1R, I need a much higher win rate than if I'm risking 1R to make 3R. And this is why a strategy shouldn't be judged by win rate alone. Number 3, expectancy. This is one of the most important numbers. Expectancy basically asks, how much do I expect to make or lose per trade over a large sample? For example, if a strategy has a 50% win rate, with winners averaging plus 2R and losers averaging minus 1R, 50% 2R equals plus 1R. 50% times minus 1R equals minus 0, 5R. That gives an expectancy of plus 0.5R per trade. That doesn't mean you'll make 0.5R on every trade. You could lose 5 trades in a row. You could have a bad week. You could even have a bad month. But over a sufficiently large sample, the positive expectancy is what we're looking for. Number 4, maximum drawdown. This one is extremely important because a strategy can be profitable overall and still experience a drawdown that you personally cannot handle. Maybe your backtest shows that the strategy eventually made money, but at one point it went through 10 consecutive losses. Could you actually follow the system through that? Would you start changing the rules? Would you increase your lot size trying to recover? Would you stop taking valid setups? Because if the answer is yes, then the strategy might be profitable on paper, but you may not be able to execute it profitably. And that's something I had to understand about trading. A strategy isn't just about the numbers on the chart. It's also about whether the trader can survive the statistical reality of that strategy. Number 5, losing streaks. I want to know the worst losing streak my strategy has produced, because losing streaks are inevitable. Even a strategy with a genuine edge can produce several losses in a row. And if you don't know what a normal losing streak looks like, you might mistake normal variance for strategy failure. Different markets have different volatility profiles. Different sessions have different liquidity characteristics. So I want the data to answer one specific question. Does this model work on NAS100 under the conditions I'm actually trying to trade? Step 3. Record every valid setup. This is where discipline becomes important. I don't only record the trades that look beautiful. If the strategy gives me a valid setup and it loses, I record it. If it gives me a valid setup and it wins, I record it. If the setup never appears, I record that too. Because a no-trade day is still information. For every valid setup, I want to know things like date, session, market conditions, direction, liquidity swept, entry, stop loss, take profit, risk in R, result in R, maximum favorable excursion, maximum adverse excursion, whether there was major news, and most importantly, whether I followed the rules. That last part matters, because if I lose a trade while following the strategy perfectly, that's different from losing because I broke my own rules. Step 4. Don't stop after a few winners. This is one of the biggest traps. Imagine you test 10 trades. You win 8. Now you're excited. You think, I found it. But 10 trades isn't enough to understand the full distribution of a strategy. You need a meaningful sample. And as the sample grows, you start seeing things that weren't obvious at the beginning. Losing streaks, different market conditions, periods where the setup becomes less frequent, periods where the risk to reward changes, and sometimes the strategy simply stops behaving the way you expected. That's why I don't want to test until I have enough winners. I want to test until I have enough evidence. Step 5. Separate the data. This is extremely important. Don't put every result into one giant number. Break the data down. For example, high volatility days, low volatility days, news days, non-news days, trending conditions, range-bound conditions, and even different types of liquidity sweeps. Because your overall win rate might look good, while hiding the fact that your strategy only performs well under a very specific market condition. And that discovery can actually make the strategy better, not by adding random indicators, not by adding 10 more confirmations, but by understanding when your existing edge is most likely to appear. Step 6. Review the losses. This is probably my favorite part of testing, because I don't just want to know that a trade lost. I want to know why it lost. Was the liquidity identification wrong? Was the sweep weak? Was there no real displacement? Did the market reverse before reaching the target? Was volatility too low? Was there major news? Did I enter too early? Or did the strategy simply take a statistically normal loss? Those are completely different situations. And if I keep seeing the same failure pattern over and over, that's something I need to investigate. But here's the important distinction. I don't immediately change the strategy because of a few losses. I collect the evidence first. Then I look for repetition, because one unusual loss is an event. A repeated failure pattern is information. And after enough data has been collected, I can finally ask the question that matters. Does the strategy still perform when I stop controlling the environment? Because historical charts are controlled. The market isn't, and that's exactly why the next stage of testing becomes so important. Forward testing. That's where I stop looking at what the strategy would have done and start finding out what it actually does in real market conditions. Chapter 4. Taking it into the live market. Now we get to the part that I believe separates a backtest from a real trading system. Forward testing. Because eventually you have to stop asking, would this have worked? And start asking, does this actually work when I have to make the decision in real time? That's why I decided to take this NAS100 NYSE Liquidity Strategy into the live market. And I want to make something clear. I wasn't going into the live account thinking, this strategy worked in backtesting, so now I'm going to make money. No, the purpose was completely different. I wanted to collect more evidence, because the live market introduces things that a historical chart can't fully reproduce. You have spread, you have execution, you have slippage, you have real-time volatility, you have news, and then there's something even more difficult to measure. Your emotions, your hesitation, your fear of taking a valid loss, your temptation to move your stop, your temptation to close a winner too early. All of those things can change the result of a strategy, and that's exactly why I treated the live account as a testing environment, not a money-making machine. The first realization. One of the first things I noticed was that the market doesn't always behave the same way. Sometimes the setup appears exactly as expected. Liquidity gets taken, price displaces, structure breaks, the retracement comes, and the trade moves toward the target. But other days, nothing happens. The market can be slow, volatility can be low. The liquidity sweep can happen without meaningful continuation, and sometimes the clean setup simply isn't there. This is important because one of the biggest mistakes a trader can make is believing, I have a strategy, therefore I need to trade every day. You don't. If your conditions aren't present, there's no trade. And that's something I started paying much more attention to during live testing. The market condition matter. For example, I noticed that some sessions had much less movement than others. Instead of forcing an entry just because the NYSE session had opened, I had to ask, is the market actually giving me the conditions this strategy needs? If the answer was no, sometimes the best trade was no trade. That might sound boring, but that's actually one of the biggest lessons in systematic trading. A strategy isn't just an entry model. It's also a filter for when not to participate. Then came the psychology. This is where live testing became completely different from backtesting. When I'm looking at historical data, a losing trade doesn't affect me. I already know the outcome. But when real money is involved, everything feels different. You can see a trade approach your stop loss. You can start questioning the setup. You can think, maybe I should close this. Then price moves back in your direction. Now you're thinking, I knew I should have held. And this emotional cycle can destroy an otherwise good system. That's why I started paying attention not only to whether the trade won or lost, but how I behaved while the trade was active. Did I follow the rules? Did I interfere? Did I hesitate? Did I take the setup because it was valid, or because I was afraid of missing the move? Those questions are just as important as the P and L, the big lesson. And this is something I want you to understand. A live loss doesn't automatically mean your strategy is bad, and a live win doesn't automatically prove that your strategy is good. One trade is just one outcome. What matters is the behavior of the strategy across a meaningful sample of trades. That's why I'm not judging this NAS100 strategy based on one day, or 1 week, or even a handful of trades. I'm collecting data. I'm watching how the setup behaves. I'm recording the conditions. And I'm comparing the live results against what I expected from the backtest. Because eventually, I want to know, are the results close enough to what the backtest suggested? If they are, that's encouraging. If they're completely different, then I have a problem I need to investigate. And sometimes that problem isn't the strategy. Sometimes it's the trader. Sometimes it's execution. And sometimes the market itself has changed. And that's where we get into something that completely changed the way I think about trading strategies, market regimes, and edge decay. Because an edge that works under one set of conditions may not perform the same way when those conditions change. And that's what we're going to break down next. Chapter 5, The Psychology Test. Now here's something that charts don't show you. You can have the rules. You can have the backtest. You can have positive expectancy. And you can still lose money because you are the one executing the strategy. This is where psychology becomes part of the testing process. And I'm not talking about simply telling yourself to be disciplined. I'm talking about whether you can actually follow your system when the outcome is uncertain, because that's the real psychological test. Imagine your strategy gives you a valid setup. You take the trade. Everything lines up perfectly, but then price starts moving against you. Your stop loss is still valid. Nothing about the setup has actually changed. But now you're thinking, maybe I should close it before it hits my stop. So you close the trade. 5 minutes later, price reverses exactly where your original setup predicted. You didn't lose because the strategy failed. You lost because you interfered with the strategy. And this distinction is extremely important. Strategy failure vs. execution failure. When I journal a losing trade, I want to separate two things. Did the strategy fail? Or did I fail to execute the strategy? Those are not the same thing. If the setup followed every rule and still hit my stop loss, that's a legitimate strategy loss. But if I entered too early, moved my stop, closed the trade emotionally, or took a setup that didn't actually qualify, then I can't blame the strategy. That's an execution problem. And if you don't separate these two, your journal becomes almost useless, because you might start changing a perfectly valid strategy simply because you executed it badly. The fear of losing. There's another psychological problem that shows up when you start trading a strategy live. You know your risk. You know your stop. You know that losing trades are part of the system. But when the trade is actually open, knowing something intellectually and accepting it emotionally are two different things. You can tell yourself, I'm only risking 1%, but when you see that position moving against you, your brain can still react as if something much bigger is happening. And this is why risk management isn't just about protecting your account. It's also about protecting your decision-making ability. If your position size is so large that every tick makes you panic, you're probably risking too much, because you can't execute a strategy consistently while you're emotionally attached to every candle. The fear of missing out. Then there's the opposite problem. FOMO. You see NAS100 moving aggressively. You missed a liquidity sweep. Price is already running, and suddenly you want to chase it. You start thinking, if I don't enter now, I'll miss the entire move. But here's the problem. The strategy didn't give you an entry. The market gave you a move. Those are two different things. A systematic trader doesn't need to catch every move. They only need to take the moves that satisfy their conditions. If the setup is gone, it's gone. There will be another opportunity. Revenge trading. Then there's one of the most dangerous psychological reactions. You take a loss. You immediately want to make it back. So you increase your lot size, or you take another setup that you normally wouldn't take. Then another loss happens. Now you're trading emotionally instead of trading your system. And suddenly the original strategy isn't even being tested anymore. You're testing your emotions. That's why I believe your trading journal needs to record your psychological state alongside your technical setup. Before the trade, how am I feeling? During the trade, am I following the plan? After the trade, did I execute the rules or react emotionally? Because over time, patterns start appearing. You might discover that you make your worst decisions after 2 consecutive losses, or that you close winners too early after experiencing a large drawdown, or that you take more trades when you're trying to recover money. Those patterns are valuable information, the real psychology test. So for me, the question isn't, can I stay calm all the time? That's unrealistic. The question is, can I follow my rules even when I don't feel comfortable? Because trading will always create uncertainty. You will have losing trades. You will have missed trades. You will have days when the market doesn't move. You will have days when your setup appears and fails. And you will have days when you watch a huge move happen without you. The goal isn't to eliminate those experiences. The goal is to stop them from controlling your decisions, because ultimately, your strategy is only as good as your ability to execute it consistently. And that leads us to an even bigger problem. What happens when you are executing the strategy correctly, but the market itself starts behaving differently? Because sometimes the problem isn't your psychology. Sometimes it isn't your execution. Sometimes the environment that created the edge has changed. And that's where we need to talk about market conditions and edge decay. Chapter 6, Market Conditions and Edge Decay. Now we get to something that every serious trader eventually has to understand. Market conditions change. And when they change, the way a strategy performs can change with them. This is one of the reasons I became interested in something called edge decay. Edge decay basically means that an advantage you previously observed can become weaker or less reliable over time. And that doesn't necessarily mean the strategy was fake. It could mean that the conditions supporting that edge are no longer the same. Think about it this way. Imagine you discover that a particular NAS100 liquidity behavior happens frequently around the NYSE Open. You test it. You collect data. You find that it has positive expectancy. You start trading it. Then, months later, the behavior becomes less consistent. What happened? There are several possibilities. Maybe volatility changed. Maybe the market became more range-bound. Maybe the timing of liquidity formation changed. Maybe major news altered the normal session behavior. Maybe the strategy was always dependent on a very specific market regime. Or maybe the original backtest simply wasn't large enough to distinguish a genuine edge from a temporary pattern. And this is why I don't want traders to think, my strategy worked before, so it must work forever. Markets don't owe us consistency. Market regimes. One of the things I started paying attention to was market regime. A trending market isn't the same as a ranging market. A high volatility session isn't the same as a low volatility session. A normal trading day isn't necessarily the same as a major news day. And a strategy designed around Aggressive liquidity expansion may behave very differently when the market is barely moving. This matters a lot for NAS100 because NAS100 can go from extremely aggressive movement to a session where price barely gives enough displacement to produce a clean setup. If I ignore that difference and treat every trading day exactly the same, I can make a major mistake. I'm assuming the market is giving me the same environment when it isn't. This is where my live testing became important. While testing this strategy, I noticed something that really changed the way I look at trading. There were periods where the setup appeared clearly. Then there were periods where the market behavior changed. For example, the liquidity behavior I was watching didn't always appear at the same time or with the same quality. Sometimes the market gave the type of sweep I was looking for. Other times the movement was slow. Sometimes the market would sweep liquidity and continue. Other times it would sweep and fail to produce the displacement I needed. And this taught me something important. A strategy doesn't necessarily fail just because a particular setup disappears. The market may simply be in a different condition. Don't for the edge. This is where traders get themselves into trouble. They know their strategy is supposed to find a liquidity sweep, so they open the chart every day looking for one. But eventually they start seeing setups that aren't really there. A weak sweep becomes a liquidity grab. A tiny movement becomes displacement. A random break becomes structure. And before long, the trader has quietly changed a strategy. That's dangerous, because instead of adapting intelligently to the market, they are forcing the market to fit their strategy. And that's exactly what I don't want to do. If my conditions aren't there, I would rather have 0 trades than manufacture a setup just because I feel like I need to trade. So does edge decay mean you should not use your strategy? Not necessarily. This is where we need to be careful. One bad week doesn't prove edge decay. One losing streak doesn't prove edge decay. Even a bad month doesn't automatically prove that your strategy has stopped working. You need evidence. You need to compare current performance with historical performance. You need to look at win rate, expectancy, average R, drawdown, setup frequency, market conditions, and most importantly, whether the original rules are still being executed exactly as they were tested. Because before blaming the market, you have to make sure the trader hasn't changed the strategy. The big lesson, and this is probably one of the biggest lessons I've learned from testing. A trading edge isn't something you discover once and then forget about. It's something you continuously monitor. You test it, you measure it, you challenge it, and when performance changes, you investigate why. Sometimes the edge is still there. Sometimes your execution is the problem. Sometimes the market regime has changed. And sometimes you realize that what looked like an edge wasn't statistically strong enough in the first place. That's why I don't want to become emotionally attached to a strategy. I want to become attached to the process of finding what actually works. Because if the data tells me my strategy needs refinement, I'll refine it. If the data tells me certain conditions should be avoided, I'll avoid them. And if the data eventually tells me that the edge is gone, I need to be disciplined enough to accept that too. Because the goal isn't to prove that my strategy is right. The goal is to find something that has a measurable advantage and protect that advantage for as long as the market allows it to exist. And now we arrive at the final question. After the backtesting, the statistics, the live testing, the psychology, and the changing market conditions, how do I actually decide whether I have a real edge? That's what we're going to answer in the final chapter. Chapter 7. Do I actually have an edge? So after everything we've covered, the backtesting, the statistics, the forward testing, the psychology, and the changing market conditions, we finally come to the question, do I actually have an edge? And honestly, I don't think the answer should ever be yes because I won a few trades. That's not enough. For me, having an edge means having evidence. It means the strategy has been tested across a meaningful sample of trades. The rules are clearly defined. The results are recorded. The losses are included. The expectancy is positive. the drawdown is understood, and most importantly, the strategy can be executed consistently without constantly changing the rules. But even then, I don't want to say this strategy will always work, because no strategy works forever under every market condition. What I can say is, based on the evidence I've collected, this is a model I believe is worth continuing to test, and that's a much more realistic way to think about trading. Here's the framework. If you're testing your own strategy, I want you to remember these questions. Number 1, is the strategy clearly defined? Can someone look at your rules and know exactly what qualifies as a trade? If the answer is no, you can't properly test it. Number 2, did you test enough trades? Don't build your entire confidence around 5 or 10 winners. You need a meaningful sample. Number 3, did you record the losses? If you're only collecting screenshots of winning trades, you're not testing. You're marketing the strategy to yourself. Number 4, does the strategy have positive expectancy? Win rate alone isn't enough. You need to understand the relationship between your winners and losers. Number 5, do you understand the drawdown? Because if your strategy can experience a certain losing streak, you need to know that before risking serious money. Number 6, can you execute it live? A strategy that works beautifully on historical charts, but you can't follow in real time, isn't useful to you. And number 7, does the edge survive changing conditions? You need to keep monitoring it, because the market can change, and if your performance changes significantly, don't immediately panic. Investigate. Maybe your execution changed. Maybe your sample was too small. Maybe the market regime changed. Maybe the setup itself needs refinement. Or maybe the edge was never as strong as you thought. The biggest lesson. And I think this is the biggest lesson from this entire process. You don't need to know with absolute certainty that your strategy will win the next trade.